All right, let's talk about derivatives. Now, that word might sound a little intimidating, maybe a bit complicated, but I promise you, it's built on an idea that's actually surprisingly simple.
So, let's start with a question. Imagine you're going to need to buy something really important, say a ton of wheat for your bakery, but you don't need it for another 3 months. How on earth do you agree on a fair price today when you have no idea what the market's going to look like then? That one simple question, that's the key to understanding all of this.
You see, this all boils down to one fundamental problem. Nobody knows the future. And that uncertainty about future prices, it creates two very different but equally stressful worries for buyers and for sellers.
So on one side, you've got a farmer. She's out there growing wheat, and all she can think is, what if the price crashes right when I'm ready to sell? My whole year's profit could just disappear. And on the other side, you've got a baker. He's thinking, what if the price of wheat goes through the roof? My flour costs would be insane. They're both staring down the barrel of price risk, just from opposite ends.
So what's the simplest fix? Well, they could just talk to each other, right? Make a good old-fashioned deal. And that brings us to the most basic form of a derivative, something called a forward contract.
A forward contract is really just a private, customized handshake deal. Our farmer and baker get together and they agree, okay, in 3 months, I'll sell you this much wheat for this much money. And just like that, poof, their worries are gone. The farmer has locked in her price, the baker has locked in his cost. Price risk eliminated, problem solved, right? Well, not quite.
See, the very thing that makes this deal so simple, its privacy, its informality, is also its greatest weakness. Because at the end of the day, it's all based on a promise. And, sometimes promises get broken.
Yeah, just think about it for a second. What happens if the market price of wheat skyrockets? That farmer is going to be really tempted to just forget her deal with the baker and sell to the highest bidder. And if the price crashes, the baker's going to be thinking, man, I could ditch this deal and get my flour for way cheaper somewhere else. Suddenly, you've got a brand new kind of risk.
And this is where we run into the two giant flaws of these handshake deals. First, there's what we call counterparty risk. That's the very real danger that the other person in your deal is just going to walk away if the market moves against them. And second, you have liquidity risk. Because this is a totally custom deal between two people, you can't just sell it to someone else if your plans change. You are stuck.
So, to solve these problems, the market had to get smarter. It had to move beyond these private promises. What was needed was a central, reliable, and totally transparent system. And this is exactly where futures contracts come into the picture.
The big idea, the absolute game changer, was moving from a private agreement between two people to a public marketplace for everyone. And believe me, that one shift changes absolutely everything.
And you can see the huge differences right here. Forwards are private and custom-made. Futures, they're standardized and traded on an open exchange. Why does that matter so much? Well, because every contract is the same. The exchange itself can step in and guarantee the deal. Counterparty risk, gone. And it also creates a ton of liquidity, meaning you can jump in or out of a position whenever you want.
So how does an exchange pull off this magic trick? It's really a clever 3-step system. First, it standardizes everything, the amount of wheat, the quality, the delivery date, so every contract is identical. Second, a part of the exchange, called a clearing corporation, becomes the ultimate middleman. It becomes the buyer to every seller and the seller to every buyer. And third, to make sure everybody honors their deal, the exchange makes both sides put down a good faith deposit. We call that a margin.
Okay, so now that you've built this amazing, trustworthy marketplace, it's not just for farmers and bakers anymore. It starts to attract a whole new cast of characters. And in fact, the market really needs 3 different types of players to work properly. First up, you've got the hedgers. Think of them as the risk avoiders. These are the folks like our farmer and baker, or maybe an airline worried about the price of jet fuel, or a big company worried about currency swings. They use derivatives to protect themselves from price moves they don't want to deal with.
Then you have the polar opposite, the speculators. These are the risk takers. They don't actually have any wheat to sell or flour to buy. Nope, they're simply betting on which way they think prices are going to go. And here's the crucial part. They are the ones who absorb all that risk that the hedgers are so desperate to get rid of. Without speculators, the whole system doesn't work.
And finally, we've got the arbitrageurs. I love this. You can think of them as the price police of the financial world. They're constantly hunting for tiny, temporary price differences for the same thing in different places. They profit by buying low over here and selling high over there. And in doing so, they make sure prices stay in line and the market stays efficient.
Okay, so a farmer, a baker, a speculator. It all makes sense for a bushel of wheat. But what does any of this have to do with the massive, complex world of global finance? I mean, why should you care?
Well, because this exact same logic, this fundamental idea of managing risk, it applies to pretty much any asset you can possibly think of. We're not just talking about wheat anymore. We're talking about the value of currencies, interest rates, individual stocks, and even entire stock market indexes like the Nifty or the Sensex.
And this isn't some Wild West marketplace. This entire ecosystem is highly regulated and governed by institutions like India's National Institute of Securities Markets. It's pretty amazing when you think about it. The basic principles designed to help a farmer sleep at night now form the absolute bedrock of how the entire global financial system manages risk.
You know, there's a line that sums this all up perfectly. It says that the derivatives market's whole purpose is to enable the transfer of risk. That's it. It's a system designed to move risk from people who don't want it, our hedgers, to people who are willing to take it on, our speculators.
Which kind of leaves us with one final, huge question, doesn't it? If these powerful tools were designed specifically to manage risk, why do we so often see headlines about them creating massive risk? And that is definitely something to think about.